Hi, it's Aoife and Devitt, and welcome to an abbreviated Markets Happy Hour podcast for this week. It is Thursday, August 6th. I'm recording this at about lunchtime, Central European time. This is a fake background behind me, but it's not too fake in that it is a picture on the wall at a hotel in Interlaken, Switzerland. So it's not quite the actual scene of Interlaken, but it probably looks a little better as there would be quite a bit of background noise otherwise. So I'm coming to you from a vacation here. But let's have a short update and bring up the slides. I called this week's podcast Trips to Nowhere, as I did have a trip to nowhere of my own this week. Anyone who looks at the videos on LinkedIn will see that. I had a round trip to Geneva Airport for a flight that ended up being cancelled, consisted of 10 hours round trip to this Interlaken train station. So it did amuse me, as we've spoken about bridges to nowhere and trips to nowhere. It seems we're also taking a bit of a trip to nowhere when it comes to geopolitics too, as we look at the Strait of Hormuz and the on again, off again actual conflagrations there and kinetic warfare. When we see that occasionally there is a memorandum of understanding, there are threats made, there are threats put on ice. It does seem that we are in a bit of a round trip in that case as well. And we can see that the only real area of markets that is affected to date has been the oil price, but it is sowing this uncertainty that markets need to contend with on top of all other kinds of uncertainty. In terms of the topics I'm cycling through, we have inflation, interest rates, geopolitics, equity markets, and other asset classes. We will touch on venture capital and some of the returns that we're seeing in that asset class today and speak about whether it is holding its own as a place in a portfolio or whether the comparison is simply too challenging if it is being compared to public equity markets. In terms of our subtopics this week, we will have the trips to nowhere I mentioned when it comes to geopolitics. We'll speak about how bonds are getting bolder and they're continuing to second guess not only the Fed, but also the Japanese central bank, and to think hard about how we get to think about the current fiscal situation in economies around the world and whether bonds are taking that at face value or are actually sowing some more seeds of dissent there. We're going to discuss equity news flow and, as I mentioned, venture capital returns, some of the venture capital headlines, and ask whether the new normal is grow or die when it comes to venture capital. Let's talk about inflation. So we've got two mixed messages on inflation. We still have high gas prices in the US, which is making the focus on the Strait of Hormuz situation even more acute. We can see that the average gasoline price, having topped $4.40, is now creeping up again, having dipped below $4 a gallon. And this was in just over the last few weeks, we've seen with the tensions restarting that this has led to this creep upwards. We know also that the June inflation figure was probably a bit of a head fake in that it did not reflect the current certainly the situation around tariffs, but it was probably an aberration and not actually true in terms of the direction of travel. If we look, though, at the inflation expectations, whether it's due to the sense of the administration's talking points or Kevin Warsh's talking points, we can see that inflation expectations have come down, and swaps are predicting that US inflation will fall below 2% over the next 12 months. So a very important metric nonetheless, as we begin to look at this as a direct link to the interest rate policy. What we did see just last week was bonds selling off because they did not expect that the Fed would be able to get inflation under control and would be forced to raise rates. So this again is a suggestion that expectations may not be sitting with reality at the pump, but certainly not sitting with reality when it comes to bond market behavior. If we look at what's occurring in equity markets, clearly there's a lot here that I haven't put slides for, but I'll talk through some of the dynamics we're seeing in any event. We have seen markets turn around over the course of the week. We've seen them rally again back to new highs, having had a significant dip at the course of the week as there was concern around not only the earnings, but also some of the spending that we've seen. We can see that investors are on the one hand still concerned about large levels of AI spending. We saw that in terms of how they penalized Meta, have penalized SpaceX over the course of this week when it announced in its earnings on Tuesday evening the significant increase in AI expenditure that it would have on tap. And this clearly, combined with the selling pressure of some of the technical overhang in SpaceX, that led to some concerns that this was not going to be perhaps the smooth trajectory of revenue growth that will be combined with the significant expenditure. There does seem to be not universal acceptance of the need for this strong cash flow out level that we're seeing from many of the hyperscalers. It depends really on the ability to generate income and revenue on the top of this additional spending need. If the revenue does not match the spending, we're seeing very little tolerance for that. I think if we're also looking at what occurred during the week, we had situational awareness. At the end of last week, we saw that hedge fund unravel, classic case of being over levered. 4x was the rumor going into a particularly volatile market with semiconductors as well as AI names, including hyperscalers, particularly volatile, precisely the kind of asset that one is always warned about applying leverage to. Well, we can see that by this chart, situational awareness is not the only hedge fund that has got that level of leverage in place. We've seen the level of leverage creeping up. If we look at this blue line, the leverage of the prime brokerage has been creeping up since 2020 from 1 trillion to closer to 3 trillion. So adding, and it's a 3x in that sense. And this would perhaps be a reflection of the low level of volatility that we've seen in markets, but equally the reaching that's been going on for yield and return as markets have continued to deliver well ahead of expectations. So this has been interesting because you would typically think that when markets deliver in such a way that there would not be that level of leverage, that there is not this hunger for yield, but it does seem that one strong return simply leads to another need to compound strong return. We spoke last week about Europe being the anti-tech index, and that has generally actually played quite well for it over the course of the year to date. The anti-tech has been there as a port in the storm when there has been a sell-off in tech. And there's also some participation in tech by Europe. Much of the news flow we see around Europe is around AI sovereignty and Europe also participating in this wave of AI. We're seeing some interest from AI companies in the US opening outposts in Europe. And there's generally been a rising tide lifting all boats. So Europe is not a one-trick pony when it comes to the anti-tech, more traditional areas of that. What we can also see, though, is that the earnings strength, which has been strong, not exceptionally strong in the US, and this is generally what's been pushing the indices this week towards new highs. So we have an exceptionally strong set of earnings in the US. We have a decent set of earnings in the European zone. You can see the European 12-month earnings and sales growth estimates have been about 16.5%. So not shabby at all. The UK participating in that to the degree of 13.2%. This is the chart, the red chart on the right. The US is ahead with 20, and then emerging markets ahead again with 36.7. Their earnings have been very, very strong in terms of being close to 40%, and sales there in excess of 10%. So very old-fashioned, stereotypical EM levels of growth that we're seeing there. And this has been a sign that even though the US has been definitely grabbing the headlines, there has been a solid participation across the board, including even Japan, which has been certainly subject to much technical influence over the year to date. And we'll talk a little bit about that intervention in just a minute. If we look at the European stock indices rising to records, there is a suggestion that Europe is no longer a laggard. It's certainly been a welcome participation since the beginning of the year in the strong rise of equity markets. As we know, this doesn't always translate into Main Street participation in Europe. Main Street and Wall Street seem to be much more divided in Europe than they would be, say, in the US. But this is a very positive sign of having European stock indices rising to records. Looking at other areas of perhaps signals where we would see futures leading, reflecting the demand and the expectation. Copper, again, seeing its ascent. It has been some volatile movement in there in the year to date, but still very strongly up and to the right. Copper, this, of course, will benefit the suppliers, countries such as Chile. But generally, the demand for copper does tend to correlate directly with the expectation of growth in emerging markets as well as developed markets. And what we can see is that given the very strong demand for AI infrastructure, there has been an ongoing strong demand for copper. And this is, of course, going to press on that inflation number that we spoke about earlier. So again, when raw materials such as copper, as well as oil, when this continues to rise, it is hard to see why inflation expectations have been so subdued and are in fact falling. So this is really one of those cognitive dissonance moments when we have to ask, how could inflation expectations be falling when we have something like copper, a key raw material, rising to this degree, and when we have the expectation around expenditure in AI and in AI infrastructure rising to that degree. So this level of expenditure, not simply from the consumer, but from the corporations, that the level that they will drive up raw materials and infrastructure prices, this will translate into inflation. So a lot of mixed messages here would make us wonder whether there is one inflation number, perhaps a consumer inflation that has been seen, or whether we should be looking at a more complex blend of corporate and supply inflation, and then think about the actual price at the pump or the price in the grocery store, which is, of course, the consumer price that will drive sentiment and drive the affordability question. The last topic I want to talk about today is venture capital. I have been writing and blogging a lot about UK local investing, and in particular about the opportunity for UK venture investing as the third largest ecosystem in the world after the US and China, whether this investing ecosystem will see its potential now that a £1 billion scale-up fund has been announced. And we know that the large body of institutional capital in the UK is at least showing that it is inclined to investing in this. There was a couple of cautionary tales around venture capital this week, and one in particular is the acquisition by Bending Spoons of Airtable. We've seen this described as a kick in the gut for software unicorns and their backers. And beyond the highlights of the fact that it had a $2 billion valuation, it was important to scrape that back and see that there was over $1 billion in cash on the balance sheet. So the actual price paid for the assets there was less than $1 billion. And if we do go through the cap table, what was very interesting to see is that the price was a fraction of its last private valuation. And picking into the data again, we can see that the growth rates had simply not been met. In the case of Airtable, that there was some of the sales reps had failed to meet their target. Only 30% of the sales reps had met their targets, and there was a real sluggishness starting to set in. This company had in fact spun off an agent which had been part of its mesh of businesses previously. Arguably, a lot of the value could actually now attach to an AI agent that was tied to that company's own product mix, and that the actual assets that were left in the company were probably the assets that were not seeing that level of growth. But the message that has been taken from this Airtable acquisition by Bending Spoons, which have a reputation now for turning around companies that are perhaps sluggish, slimming them down, cutting staff, and automating processes and applying AI essentially to really take them to the next level, that may be very successful. But what we can see from Airtable itself is that to achieve this disappointing valuation, their growth clearly was not at the standard that the market is now expecting. One of the messages that came from that is that the 2026 venture landscape is now grow or die. And when we've seen the kind of growth statistics that are coming out of the inference businesses, the AI businesses, this staggering month-on-month growth in revenues. And I will tie this again to the 47% increase in revenues period on period in the S&P. We are now, as a market, starting to expect far higher astronomical revenue growth. Even Palantir, Alex Karp, had described their revenue growth as otherworldly. When we start to see statistics around revenue growth that is otherworldly, so not something that we can identify with and not something that we've seen before, this is when we know that the bar has been raised significantly in order to get to that point that there is a need for much, much higher growth. And I do think it's a good time here to think about the venture capital returns. And we'll be doing a lot more on this in months to come. But one of the factors, if we look here in terms of picking into venture capital, this Airtable acquisition was an occasion to pick into venture capital returns. And we all know about the power law in venture capital, which is that a tiny fraction of the portfolio companies drive the bulk of the returns. There is a tendency to have a correlation between those venture capitalists who can pick the strong managers versus those who do not have the same reputation, that there has been a pattern and a tendency for this kind of picking of strong portfolio companies to repeat. So the power law really becomes even accentuated in that way. But if we look at some of the statistics around venture capital returns, what we can see when it comes to venture capital returns is that in terms of the total value to paid in investment multiple, which is the focus where most venture capital is, that the 75th percentile of venture capital is only returning 2x in terms of TVPI, and that might be deemed as not good enough. The 90th percentile returning 3.4, so pretty good. 95th, 4.72, and then the kind of the wildest dreams or the needle in a haystack, the 13x at the 99th percentile. But the fact that the 3.4 is at the 90th percentile just illustrates just how much venture capital to return, simply return of capital itself, is actually now very much the norm for the bulk of venture capital funds. And remembering again that the late stage investors in Airtable would just have had one turn of their capital returned, not even seen any return on that. If we compare that then to public equity markets, some statistics here suggest that the S&P over the last 10 years was a 4x in terms of a TVPI, similar 15% IRR. The NASDAQ 6.4x, 20.4% IRR, and then FANG stocks themselves 8.3x or 23.6% IRR. So this suggests that if we were to see the S&P in venture terms, the S&P would have been behaving at greater than a 90th percentile of venture capital returns, and that the NASDAQ and the FANG stocks would have been higher than the 95th percentile. This is important because I think we really have to have this conversation about venture returns. If we expect venture to necessarily deliver the high returns and to be there for a return engine, or if we consider venture to be there for a return diversifier, that it will still deliver equity-like returns over a different time period, and there will be more lumpiness in that. But equally, whether there is an added benefit to being invested in venture, which could be the access to innovation that this provides, as well as seeding and leading to the investments that spawn the next wave of FANGs. So there does seem to be sufficient capital in the system, whether it is with the existing venture players or with institutional investors, that there is a body of capital allocated to venture capital that knows about the range of returns that are possible. But I think it is important to look at the recent equity returns and realize public equity, just how challenging a benchmark that is for venture capital to meet. And if we were then to think about the role of venture capital in a portfolio, if it's simply a return engine, it's not currently earning its keep, at least on average, versus public equities. But if we see it as I said, a diversifier, as well as a way to get exposure across the value chain to the companies today that will be the FANGs of tomorrow, that's another way to think about innovation. And when we think, of course, about local innovation, whether it's the UK, European country, or elsewhere, getting in at the ground level in the companies of tomorrow and allowing them to be based elsewhere outside the US, allowing them to get funding outside the US, that could be a reason that it has more of a long-term return, although in the near term, there's still going to be that uncertainty that attaches to all venture capital. So that is our short set of comments for this week. I look forward to seeing everyone back next week. We will have a special guest next week. Look forward to that. Actually, the next 2 weeks, we're going to have special guests. So have a great start to August, everyone, and see you next week.